Now, here's a behind the scenes view of how I would approach qualifying this client. So let's review. We have a young couple, newlyweds. They're currently renting in uptown Dallas. Dual income, so the wife works for a company in downtown Dallas. Husband is self-employed, has his own business. They want to move to the suburbs and they plan to have children. They've budgeted for $500,000 purchase price with 20% down. So here's how I would go about it. Step one, we would just have an initial call. So we would review where they want to live, what's their timing, so when do they plan on moving. In the example, we talked about September 1st. We also just briefly talk about income sources. That's where I would find the information where the husband is self-employed and how he reports his income. So in the example, he says he was a sole proprietor. So for me, that automatically means that as a lender, I'm listening to that and I hear Schedule C, which is where he reports his personal income on his personal tax returns. He reports his business income on the personal tax returns. We'll also ask about assets. Do they have enough for a down payment? What's the source of that? Is it from family? Is it from their own personal assets? And if they were to sell a home, is that coming from proceeds from a sale of a home? These are all questions that I'll ask on the initial call. At that point, not everybody has gone through the process of getting a mortgage. So I would also find out if they have any questions. Have they spoken with the lender in the past? Have they ever gone through the pre-approval process? I just want them to feel comfortable going forward. And then assuming we're ready to move forward, I'll take down their personal information. So I will take down their full name, their social security number, the date of birth. I'll also look at their where they currently reside. And then that's just gathering information so that I can run the credit. I'll also take down a phone number as well as their email address for follow-up. So the next piece right here, once I have all that information, the personal information, I'll enter it into my program. On my side, we're starting the loan application at that point. I run the credit. So right here, you can see over here, this is tri-merge. So what I'll do is I'll enter in the information, hit run credit on my side. And what I'm looking for is I'm looking for what the monthly payments are. It automatically calculates it for me, which is pretty nice. But it also will tell me if there's any late payments. So this 30, 60, 90, I'm paying attention to that. We want zeros, right? So if there's any ones or twos or anything over here, that tells me that we may need some explanations if there's any late payments. I also want to make sure if there's, there aren't any derogatory credit events. There are waiting periods for bankruptcies and foreclosures and short sales, but it'll show up on the report. It may not just show it right here. It may show it later in the report. So that's important to go through the entire report to check. Also, from a qualifying standpoint, we use the middle score of the lowest borrower. So in this particular case, we have 3 scores. We have TransUnion's at 786, 783 for Experian, and 777 for Equifax. So for this case, I'm using the middle score, which would be Experian. So the borrower is going to be qualifying at 783. So in the next page here, what I'm doing is I'm creating the to-do list on my side. So what I do is I will go ahead. We've got a great system called TransferSafe. I'm asking for the wife, I'm going to ask for the 2 years tax returns, 2 years W-2s, 30 days of pay stubs, as well as 2 months of bank statements. And then for the husband being self-employed, in addition to looking at his Schedule C on his personal return, I'm also going to ask for a year-to-date P&L, so a profit and loss statement, as well as business bank statements, if he has any business bank statements. As of June 11th of this year, Fannie and Freddie, they have released additional guidance for COVID. So now we have to review profit and loss statements year to date to the earliest month. So that's additional information that I'll ask. Because they're newlyweds, they probably have their own tax returns from previous years, 18 and 19. So I'll ask for their individual returns. The next piece here, this is just what the client gets. This is TransferSafe. This will just show on their side once they click the button. So I send them an email invitation. They start their checklist. They're just dragging and dropping, just pulling up information one to another. So it's really simple. It's secure. And when they hit submit, I'm able to review all of their documentation. We really strive to eliminate as much as possible in terms of paperwork. Okay, so now we get into calculating the income. So the wife, she makes $60,000 a year, so that translates to $5,000 a month. Pretty straightforward. For the husband, I have all different types of calculators. So I have clients that have S corps, C corps, LLCs, LLPs. In this particular case, we said Schedule C, so that's sole proprietorship. So what I'm looking at here is I've got a calculator on my side. So just hypothetically, in 2019, husband made $80,000 in net profit. So I'll enter that information here. 2018, he actually made more money, $100,000. But because this is important, because the income is going down, I'm using the most current year. So we're always going to look at a worst case scenario. If the numbers were flipped, the actual number would be 90,000 qualifying because we would average the 2 years. We put in deductions for meals and entertainment. So it's a deduction here for 50%, but I just put it in the calculator and it tells me. So I've come up here and I've got an average monthly income of $6,500. I'll also compare the year-to-date P&L and make sure that from a monthly standpoint that net income number is at 6,500 or higher. If it's less, then we have to use the worst case scenario. And if it's significantly less, the borrower may not be able to qualify as it indicates that income is not stable. That unfortunately is a challenge in this day and age for self-employed borrowers in the time of COVID, but hopefully it all gets better. Okay, so now I'm going to do a quick review of the assets. I'm looking at your bank statements, so I'm looking for the transaction history, and don't worry, I'm not going to judge you if you where you're eating or anything like that. I just want to make sure that I'm looking at in terms of the deposits. If there's any large deposit that's over half of your regular wage, we're going to need to explain it. So that's through a letter of large deposits. I'm also seeing if there's any income coming in from relatives or family, anything like that, because in that case, we'll need a gift letter. So it's important to send over the bank statements, and I need 2 months of it. The next piece here, I run the numbers. So I'm factoring in the outside debt. So I'm looking at car payments. I'm looking at student loans, any sort of credit cards. That's information that I'll have from the outside standpoint. Once I have my outside numbers, I've got my numbers for the monthly payment. I'll go in and I'll price the loan. So I will run it through based off of a FICO score. That's going to be the primary determinant. Based off of also down payment, I come up with my monthly PITI, which stands for PI is principal and interest, or the mortgage payment, plus property taxes and insurance. And then to calculate my debt to income ratio, which is a very key number, and just for folks that are have questions about the DTI, on average, you want to target about 43 and below. You're going to qualify with most programs with 43 and below. Certainly there are some programs that allow you to go a little bit higher, especially if you have compensating factors. But for the sake of this particular exercise, we want to look at the debt to income ratio. So once I've determined that DTI, and I get that by dividing the total monthly debt, because everything's expressed by the month, and divided by the income. So I'll take that 5,000 plus 6,500, so that's 11,500, and then I'll factor in all of the other payments that are associated with the loan. So the PITI plus the outside debt, and that gets me my debt to income ratio. As a next step, I'll send the file through my automated underwriting system. What the automated underwriting system tells me is, number one, I want it to have an eligible accept. This is with Freddie Mac. So it's called LP, or Loan Prospector. But then I'll also look at, sometimes I'll look at Fannie Mae, which is Desktop Underwriter, or DU. The goal here is not just to get that eligible accept, but it also is I want to know what the underwriter is going to be asking for during the file. It actually will, so if you were to scroll down in this report, it actually tells you specifically what's required. So it'll say that, for this particular self-employed borrower, we need 2 years of tax returns, or we need a 5-year history. So it'll actually say what we need. So not every loan officer reads that. I'm not sure why, but in my experience, it gives the roadmap. And that's really what is important, because when you're discussing how to set up a loan with the client and what it's going to look like, you want to create that path. You want to make sure that it's a clear path and the client can meet all of those objectives. Otherwise, it's going to be a rocky experience, and we don't want that. Okay, so now I have my eligible accept. I do a final review. So I'm going to re-review the credit report. I'm going to see if there's anything that I missed. I'm also going to recalculate the income, look at it for a second time or third time. I'm going to review the assets. And then I'm also going to look at our initial call. So if there's anything on there that I missed, I want to make sure that I'm ready to have that conversation with my client. I'll also compare loan programs. Sometimes, Fannie Mae may have some better pricing by the time I get to this particular stage, or Freddie Mac might be better, or maybe even look at it from a jumbo perspective, or FHA. So I'm going to look at it different ways. I'll also see if the borrower were to put down 25%, or 30% or 40%, what impact that would have on rates if those are options for the client, based again on my notes from the initial call. Okay, so now it's time to discuss the findings with the client. I'll go over the programs. I will ask them what they think about those payments. What do they think about, knowing that, these are the estimated payments? Are these things that they can meet? I'll also bring the realtor into the conversation. So at this point, I'm calling the realtor and saying, okay, our borrower, we're good at 500. We may have a little bit of room if we need to go up. So maybe up to 520, but we really want to keep it below the range, just in case if there's any calculations that I may have missed, or just miscalculating the income. We're all human. We're not perfect. So we just want to make sure that we're conservative and we're looking at particular levels. We don't want to get right there to the edge and then have something that pushes you over. Okay, so now the next piece is the pre-approval. So personally, I like to customize my pre-approval letters. So if the agent comes back and says, okay, we're going to make an offer, it's going to be $500,000. I'll put together the pre-approval letter for $500,000. I'll also work with the realtor on the terms. So typical standard, I'm seeing is 17-day loan contingency, actually appraisal contingency, and then 21-day loan contingency. So I'm going to make sure that that we're good on all of that. If we need to move faster, we can talk about that. I'm also, if the realtor is open to it, I'll also call the listing agent. So I've done that on many occasion, especially in a competitive situation. And not a lot of loan officers do that. And it really gives the peace of mind and confidence to the listing agent, and most importantly to the seller, knowing that the lender is behind the client and understands the entire situation in terms of the overall ability to close that loan. Another big piece of that is letting them know that I'm with a mortgage bank guaranteed rate, where we're going to do that loan in-house, and I'm going to be managing the entire process. It's not going to get lost. It's not going to go into a black hole. All right, and then the final piece right here is the offer acceptance. So once our offer is accepted, I'll re-review the current rates, pricing, and payments with the client, and provided that we're ready to go, then we'll go ahead and lock in the rate and we'll start the loan process. Thank you so much for listening. I really appreciate it. And again, you can reach me if you have any questions. I'm at 310-804-8243, or you can send me an email, ron.bruno, BRUNO, @rate.com. Thanks so much.